economy, investors have found themselves confused at where to invest their money. Trust is the number one factor when it comes to cash flow and understanding security of passive income and investing. There is a system that has been developed that is not only secure, but is turning investors into philanthro investors. Investors with ethics, integrity, and the viewpoint that helping families achieve their American dream is still very much alive in the United States today. Equity and Help is a company founded on integrity, ethics, and help. The focus is purely on the concept of helping families move into stable homes, save neighborhoods, and for investors achieve cash flow that is stable and secure. Imagine putting your money to good use and helping families all the while making a passive income. That is Equity and Help, restoring faith in investing and giving help to families all across America. Learn more and become a philanthro investor at equityandhelp.com.
Have you ever lost money in the speculative investment world? Did you feel out of control? There's a direct correlation between knowledge and success. Greater insight and control leads to greater success of your portfolio. At Equity and Help, we know it's not up to you to do the hard work. That's on us. That's why we place you firmly in the driver's seat. Did you know when you join us, you have access to a real estate philanthro investor matrix? You'll benefit from a dashboard full of information and key indicators for you to remain in control and make the key decisions. Become the CEO of your portfolio and let us handle the hard work while you earn 8 to 12% returns and help families across the U.S. Start now. Invest with a purpose at equityandhelp.com.
Hello, and welcome to our weekly webinar. Today, we're going to talk about how to avoid accumulation of losses. And you are stuck with me instead of Sky Logan. Sky's a little bit under the weather, so I'll be taking over for him today. And it's very fortunate because this is a topic that I really, really like. If for you guys that you don't know me or have never worked with me, I am the Senior Vice President of Sales and Marketing here in Equity and Help. And yeah, let's head right into our topics today. A lot of our investors know me because I work with them a lot and make sure their portfolios are nice and good. And yeah, let's head right on. Pretty much the first thing I want to address is to show you what your average person, your average investor will be doing and kind of what are the symptoms of the market and overall, how does this affect you as an investor, right? It's pretty simple. There's always the fluctuation in the market. Sometimes we have a high market, sometimes we have the valleys, so commonly known as peaks and valleys. Very simple. Once the people start to get into a certain investment, let's use, for example, stocks, right? We start going in, everyone's like very optimistic that it's going to be a good investment. Everyone's very excited. There's a spreading of the word that this investment is going to work out and everyone starts to jump in. So it goes from optimism where you are, okay, I hope this works. You're kind of doubting yourself a little bit, but you're excited. And that initial excitement is more like optimism. Then you start getting your friends in and now there's collective excitement and everyone wants to come in, or at least your inner circle, the people that you know very well. Then it starts going up. You know, this investment starts producing, the value of it starts going up. And now there's a lot of excitement. There's a lot of people that are coming in. Now it's starting to be popular, right? And now it goes from it being exciting and you seeing your earnings and seeing everything go up. It's, oh, so cool. Everything's going good. And now there's a lot more of that energy. It becomes euphoria, right? And that is where pretty much, I'll give you a little anecdote in a second, but that's pretty much where everything starts to go south. When everyone has found out about this investment and everyone has put money into it and it's lost its potential to grow. So what happens here is, I have a story from a friend in Canada. He used to tell me that when he was doing a lot of stocks, there was a time in his life where he had hired a person to clean his pool. Now, the person that came over, for you to have some context, was not the owner of the business. It was not the manager of the business. It was just a regular employee, the person, the pool boy, to call him something colloquial, right? And he would come and they would always talk. He's a very friendly person. He's kind of like me. He believes that you should always treat everyone equally. And he would always talk with this pool boy, right? And everything was nice, fine. They always talked about whatever was interesting to this person, because obviously he wasn't going to talk to him about, big investments or, how to make an online business, which is what he does. So one day, this pool person comes over, and instead of them talking about, the what he was going to do that weekend, maybe that little family gathering that he was going to have, they start talking about stocks, and something lit up in his brain where he said, "Okay, this is an average person in my country, an average worker, and he's all in on this stock thing. Maybe it's time for me to step aside for a little bit." And he did exactly that. So what happened is he kind of got the best out in the best time. And this is what a lot of people call timing the market. And well, just as the curve shows, here's what started happening. The stock started dropping in price because now there's way too many people having it. And a lot of people started to sell it either because they were a seasoned investor like my friend, or because they started to see the price dip. And now all the excitement starts to go away, right? And now some people start going into denial and they say, okay, it will bounce back up. Let's just wait. It will bounce back up. It keeps going down. And what happens is now you're anxious. Wow, is it really going to come up? Is it really going to bounce back? What should I do? There's a lot of uncertainty here as well. And that's where a lot of bad decisions are taken. Versus if you were a seasoned investor like my friend, you would know, okay, I'm either going to ride the wave out or I'm just going to cut my losses and call quits, right? Then it keeps dropping. And what happens is now you're in fear because you don't really know exactly what's going to happen. And you've evolved from, being jittery and being, maybe it's going to go up, maybe not. I don't know. Now you're in complete fear. What starts to happen is it starts to sell. And just like you, other people that have been in here that are not necessarily well educated on this, and they were just kind of writing it, they start to also quit. Now, the stock keeps on going down, and the few people that held without knowing exactly what they were doing started going into panic mode. This escalates really quick. This graph makes it seem like it could be very many days, but it really could be a matter of hours, really. That's how fast something speculative like stocks can go, and we'll go into some examples in a little bit. But anyhow, that then goes into many other negative situations where it reaches the valley, it reaches the lowest point. And that's when a lot of people go out because they say, wow, I've lost a lot of money. I've been burned. That's it. I'm done. Okay, now I'll just leave now. And for the more seasoned investor, that's when my friend started to purchase stocks again when he saw them at their lowest point. And the average person would then go into skepticism. They would be, okay, is it really going to keep on picking up? Is this just a little one of those things that happen in a few hours and then it goes back down? And, as it starts going and creeping up, it evolves into hope, and it becomes this vicious cycle of, okay, maybe we should go in and put more money in, right? And by the time you decide it's time to put money in, you're right where you started this whole cycle, right at optimism, where the stock was at an average price. It was probably where you could have invested, made some money. But really, since you didn't know what you were doing, you might have already lost a whole bunch of money by buying maybe at optimism, but selling at depression or at despondency. Right? And this is something that repeats itself. The market is cyclical. At the same time, it does have many variations in the process. It's not a straight line. Of course, it has ups and downs on a daily basis, on an hourly basis. But overall, this is kind of what it looks like and what the average person and the average human, to say something, goes through, right? And if you don't really know what you're doing, and if you just follow what everyone's doing, what ends up happening is you go into the market cycles that, for example, in 74, there was a 34% recession. And that's normal. It's not abnormal. It's kind of what happened in 08. There was a 37% market crash. And we call these big names. We call them, the Great Depression. We call it the market crash of 08, whatever name we use, but it's cyclical. If you come and look at the history of the market, it's just the way it goes. Nothing can go up forever. And of course, it tends to then go down because of many people going in, a lot of relation between what's demanded and what is available. And that's how it goes. There's many crashes that have happened. We saw in 87, a 28% market crash. We also saw in 02, a 22% market crash. And many scandals happened in 02 because many people thought it was going to be like 08, what happened in 08, which is a little bit more complicated than just looking at stocks. But overall, that is the general gist of it. And there is always going to be peaks and valleys in any investment that you do. It's just the difference between doing something speculative, where it be more often, and you will need to be knowledgeable and know when to get in or out, or just to stay through and see the growth on average over time, right? And then we can look at some very specific cases that are popular right now. Like, for example, if we look at the, I call it Dogecoin, but really it's Doge. So Doge is a cryptocurrency. I don't know if you're familiar with cryptocurrencies, but pretty much it was worth something standard for the most part of the time of its existence. If you see on the graph on the left, you'll see that pretty much there was minimal variance in a really long time. I'm talking about a whole year. And then all of a sudden, this whole, Reddit started to popularize it, and people started to buy it. So obviously there was a spike, and the spike was pretty much artificial, because it's just a demand created out of popularity. It wasn't really based on any real anything that could have altered the value of this crypto. And it started to go up, peaked immensely. If you see the yellow line right there in the middle of the left graph, peaked. The value went up a lot of volatility right there. Anything could have happened. It could have gone up more, it could have gone down significantly, which is what ended up happening. And then it started to kind of find a new average, a new value, a new real tangible value. And as you see, again, it spiked. A lot of the whole cycle started to happen here. And this is a matter of days. I don't know if you can read the graph properly, but in the bottom, you'll see that it's a span of a month, pretty much, where it went from being valued at cents, and it went all the way up to a couple of dollars. And it kept on going up and down, up and down. As you see, a lot of volatility going on there. A lot of people started to learn about this Reddit and started to also purchase it. Some people started to get scared and said, oh, let me just cut my wins here. Some people also said, let me just cut my losses here and let me get out. Maybe they did that at one of those low points in those peaks and valleys. Minimal, if we were to zoom in, obviously there's hour by hour situation going on there. And when we look at the graph on the right, that has been the last, week or so of this Dogecoin. And as you can see, again, very volatile. There's a lot of fluctuation, and it's really hard for a seasoned investor and someone that's really looking to or knows what they're looking at and trying to leverage this type of market. It's really hard to really work with that. So what ends up happening is probably the large portion of the people that are investing in Dogecoin are not really seasoned investors. They're just people that are on a hype, on something that's very popular right now. And that could easily lead to you making some money, yes, but it could also easily lead to you losing all of your money that you have put into this. So that's kind of the scenario there. And if we look at another good example is GME, it's GameStop. So many things happened with GameStop, many things. It was all kinds of situations that even involve legal situations. But I'm not going to get into all of those details. Let's just look at the graph and the numbers, and really as an investor, what you would be looking for, right? So if we were to be able to compare this to what's happening with Dogecoin, you will see that it's just an example of a victimizing something and you falling for it, or not falling for it if you didn't, but it victimizes a lot of people, and it really gives the industry a bad reputation. What happens here with GME is GameStop, if you're not aware of what GME stands for, you'll see that there's a lot of volatility as well. So if we compare both graphs, they have one thing in common. The real value of the stock is low. That's really what they both have in common. Because historically, if we look at what happened in 1 week or what happened over time, over years, which would be the one on the right, you'll have since 2020. So we're talking about a whole year, actually a little bit more than 2020. So a whole year of history, pretty much it's valued at very little. It's a very small number, okay? And then all of a sudden, in a matter of 2 weeks, because if you see on the left, you'll see there's January, from the beginning of January to about February 4th or so, it spiked in value significantly. It dropped in value significantly, rise again in value significantly, and then dropped to where it's actually valued at, or more or less what it's actually valued at. And that trend is really what the expectancy of this investment, of this GME of GameStop is, of the value of this stock is. So again, the same situation as before. There was something going on in Reddit, very popular place for people to go and get information. Everyone decided they were going to buy this stock because they wanted to, quote unquote, save GameStop. And yes, the price went up. Of course, the company says, hey, great, now we're valued at a whole lot more. But reality was, it really wasn't worth that much. And many things cascaded from that event. But really for the end user, for you as the investor, what happens is you get on the train, right? You get on the hype train, as they call it in the internet. You get very excited. You get very hopeful. You're, okay, I'm going to make a lot of money. And you probably bought when we were halfway through the peak, right? Halfway through. Great place to be at. You can still make a lot of money, right? What happens is you reach the peak. And in this particular case of GME, you were restricted. You couldn't even sell your stocks anymore because of many situations, legal situations even. So, okay, so now you're held hostage with this investment. And even though you maybe had the vision to leave at the right moment, you just can't. There's no control in there for you. So it's even worse. Now you're in a speculative investment, and at the same time, you don't even have control over how much you want to speculate. And that's a very compromising situation for you to be in financially. Then, of course, well, as you see, it dropped, went up again, and now when it had its second peak, many brokers started even selling your stocks for you. You didn't even have control of what you were going to do. So it's probably the worst situation. This is not common. I don't want you to think this is the common situation, but what I do want to illustrate is that you don't want to be involved in something that is just hype. It's just something that everyone's excited about, because the more people that are excited about it, there's going to be less opportunity for you to make money. When you're investing, it's the other way around. Where there's less excitement and where there's more opportunity for you to really leverage a situation, really leverage a problem, and that's where real opportunity lies, right? So if we now, straying away from stocks, let's look a little bit at the real estate market, right? And let's see what happened in 2008 and in 2020. Both years have particular situations. The bubble of 2008 had many things going on. There were people betting, shorting the market. There was a lot of not fake, that's not the correct word, but there was a lot of loans that were going out that were not really qualified loans. And there were many financial instruments that revolved around these loans that were not really secured and had really nothing to back them up. Not even credit scores were being taken into consideration at that time. Everyone and anyone could get a loan. And the market started to just rise in value, because you could buy, no matter your income, you could buy a $500,000 property, and the payment on it was so low because at the end of it, you had a balloon. So of course you would be able to afford this payment. But reality was, when this balloon came, you would need to come up with an absurd amount of money. You wouldn't be able to pay it. So eventually it was going to fail. And what ended up happening is a lot of foreclosures, a lot of properties went into disrepair, and many bad things happened out of 2008, but also many people took advantage and made a lot of money, right? If we look at 2020, and this is the graph on the right, we see that the real estate market has been going up. It, again, like every investment, has had its peaks and valleys, and everything is, but overall the trend is growth, right? It's a bull market. And what happened in 2020, we see a drastic valley, which then means, wow, for all of the people that were in real estate investing, it was a really bad year. Many things happened with the coronavirus. Also, many foreclosures were denied completely. Evictions can't happen. You can't evict people. Many people that are just living in places and just taking advantage of all these protections from the government, some of them still work, but they just don't pay rent because they don't have to. The government's going to protect them, right? And at the end of the day, they could just leave once everything's lifted, and they didn't pay rent for 2 years or a year and a half, whatever it ends up being when these restrictions get lifted. Banks have also suffered a lot. They still have loans on a lot of properties, and they can't foreclose on them. So this really has affected the market, and it has been a really tough year for most of the people that have been in real estate investing. And I say most because there are still some real estate investing that is perfectly viable, even through these turbulence. And quite honestly, they thrive. When there's a lot of turbulence like this, It's when some specific real estate instruments will thrive and will still keep you making money. Like I said, where there is a lot of issues, where there's a lot of problems, there's also a lot of opportunity. Not really when there's hype. When there's hype, there is some opportunity, yes, but it's way less. There's way less potential, and there's a lot more risk involved. And if we now go and transition into looking at these instruments, these real estate instruments, what are we talking about? We're talking about not only diversifying your portfolio, because yes, that is the smartest thing to do, not only putting all your money in real estate, not only putting all your money into stocks. You always want to diversify, and we could do a whole webinar on what diversifying is and what many instruments you have. But what does diversifying mean? In essence, it's just spreading your wealth. So dividing it into different instruments that will perform better in different scenarios, right? You don't put all your eggs in one basket. You maybe even want to look at geography. You maybe want to put some money in United States, some money in Europe, some money in, I don't know, Latin America, wherever you consider that diversification is good for you, right? You also want to practice what is we call disciplined investing, which is you don't want to get caught up in all these fads. You don't want to get caught up in all the hype and what everyone is doing. You want to do your due diligence, really find out what you're going to put your money into, and if it's really going to have the potential to perform for you, or if it's just something that everyone's excited about and the potential is minimal. And finally, time. This one is the one that I'm most passionate about, because when I talk to a lot of our investors that are, well-seasoned investors, they have been doing this for many, many years. What all of them communicate in some way, shape, or form is that they keep on investing when the market is high, when the market is low, when the market is just okay, and they keep on spreading their wealth. What happens is with time, your dollar cost average will be favorable for you. Yes, and some you will have put more money than maybe they're actually worth, and some you will put less money than they will actually worth. But over time, that means you will tend towards the middle. And that's really where you want to be. You want to have the numbers favor you and or be the more favorable they can be for you, right? Now, if we talk about equity and help, which is where we work and what we're doing here, the best thing we can do is compare ourselves to your other options, right? And there are many things that are very safe, but they will perform for very low percentages that will make you very little money. If we look, for example, in this case study that we have on the bottom, which is in black, you can see that there are 3 lines, right? The yellow one, which is dotted and whatnot, that would be something that is very low risk, for sure will perform some, and the potential for it to go south is very, 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 very small. We're talking something like what you're offered in your 401k, for example, your index funds, your mutual funds, things like that. They're great. They will perform. They will keep your money stable in some way. They'll keep it at least beating inflation, and you will at least not lose your wealth, right? Your value over time is going to be about the same. There are other things like stocks, which, yes, it has a great peak there. It has a great valley. Again, we've been talking about this for quite a while today, but you can for sure make a lot of money through stocks, yes, but you can just as easily lose it in a matter of days. And you have something like equity and help, which is the middle ground. You will have, yes, it has some risk in it, of course, like any investment, but it will also give you cash flow over time, and you will still be making that money even through market scenarios that are not necessarily favorable, just because of the way the model works and because of the way the way we have structured the model for you. And there is also another thing to take into consideration. If we send the people that are in this webinar and the people that are in our newsletter, we send you a portfolio. We are not hiding anything. We want you to see exactly what we do, how we do it. We also always show you net return. So one of the things to consider with funds, because I get a lot of people that question this funds line, and they say, well, I made a lot more than that. That might have been true. You might have you might have done gross way more than that. What happens a lot with 401ks and those kinds of investments is that they do have a lot of fees attached to them that you don't see them. You don't really see them when they show you their graphics and all of that. What they do show you is what you made gross. and it looks really nice. It really does. It would look comparable to what we do here at Equity and Help. It would be 8 to 12%, something very, reasonable, very nice for the amount of effort you're going to put in. But the reality is their fees are extremely high. All their executives get paid well before you get paid. And what ends up happening is once you factor all that in, your net return goes down significantly. So now we're talking about, on average, we're talking mutual fund will give you 4%, 3%, 5% maybe, 6, the very best ones that year. And then you would need to know exactly when they're not going to be performing to move your money to a different mutual fund. But wasn't that the purpose of putting it in a mutual fund? To not have to worry about when or how or any of that, for it to be something that you just put there and it will allow you to retire someday, right? Wasn't that the reason why you chose that investment, or why it was shown to you as a great option for retirement? Certainly that is what is shown to most of us Americans, at least. And it's really not the solution. It will just keep your money at the same value. It will keep you having the same buying power, to call it something. But when we look at something that will allow you to have cash flow growth and still be stable over all the tribulations, you want to look at something that it does have the same level of risk as any mutual fund, but at the same time, it will perform for you even through the darkest moments. If you look at the top part right there, and you'll see that the performing, it says performing, and it has a list of about 8 properties. This is an excerpt of that portfolio that we send you, and you can go and pull it up, and you can see month to month exactly what happens. Yes, it has peaks and valleys. You can see them right there in gray, right? You have months where all of the families pay, and you have months where not all of them pay. They fall a little bit behind, and then they catch up. And some, if you look at the whole portfolio, and of course you can go and do that in detail in that newsletter that we send you. Of course, you can go and see what happens exactly every month. Some properties then go, or families get evicted, and then these houses go back on the market, they get resold. It's just like if you had, for the lack of better comparison, a tenant. Sometimes your property is vacant, you just get it nice, pretty, get it looking good, and put another tenant in there. Exactly same thing. And you get a new deposit, and everything starts flowing again, right? And one of the other great things that we do here in Equity and Help is that we show you your nets. We don't want you to look at a really nice gross income when then, after you take out taxes, insurance, our fees, et cetera, you end up with the scenario with your mutual funds, right? The other thing is it's your liquid investment. So you have already put your money in, and it's just cash flow. That's it. There is no, oh, now this property is worth more. Let me see if I can rent it for more. Now this property is worth less. Oh, dang. No, so now I'm going to get less rent, and maybe I can pay the loan I have on the property, maybe break even. None of that. It's all based on cash investment. And I think I'm nearing the end, and I would like to see if there are some questions or anything like that in our chat. Right now, it doesn't seem like it. So I'm going to head into the stats for our last quarter, and we'll wrap it up with that, unless we get some questions in here. So I don't know if you've seen our previous tear sheets, but again, you can easily go into our newsletters and get access to all of that. We have been performing in many, many states in the US. Our top performers are Pennsylvania, Ohio, and Indiana. Those are the most popular right now. This fluctuates. If maybe in the next quarter, you'll see that Pennsylvania gets the lead, and then Ohio. It doesn't mean these are the only 3 states we operate in. There are many more. This is the average monthly payment that goes to investors per property. So that's a little bit under $600, which once you get more familiar with the model, you'll see that beats rent in the average rent in America. We have about a 25% average equity gain, which is, again, overperforming based on what we tell you it's going to be. We usually tell people it's going to be about 20%. You have a cap rate of about 11% right now in the tear sheet. And again, it's right in the averages. We tell you 8 to 12%. So of course, we're always striving to hit that 12%, and we're getting closer and closer every time, every tear sheet. You'll see that we have recovered over 400 homes. There's 35 million assets, and there's a lot more stats in there that I won't go into. But pretty much this, when you compare it to our previous tear sheet and when you compare it to our next tear sheet, you'll be able to see how we are always working inside those averages that we tell you, sometimes a bit above, of course. And the whole purpose of us is to show you something that's transparent, something that you can understand, that's very clear to you, because at the end of the day, that's really all that matters, is that you understand where you're putting your money in, that you're very confident that you will make a return, and that no matter what happens in the market, your asset will still perform, because at the end of the day, that's why you're putting your money to work for you, right? Can you pull up and see if there's some questions in there in our webinar? Because it kind of went into the back. There, yeah, right there. Q&A in chat, yes, both of those. Thank you. So no questions in there, and just check the other one just to make sure. Cool. So I guess we'll wrap it up here, and we'll leave you guys with another slight video for the end. Before that plays, just if you have any questions or anything you would like to discuss further with us, we're always open to conversation. You can reach out to us either through our newsletter. That's a great place. It will always have a link. You can also reach out to Sky, which unfortunately could not be here today. And yeah, if you're ready to get more information, maybe if you're already ready to hop on and start investing with us, if you are a current investor with us and you say, yeah, certainly I should put more money into this, I was looking into some other options and this has made it very clear that I shouldn't, then perfect. You can book a call with Sky. You have some links there that you can use. You can also subscribe to our newsletter. If you would still like to get more info, you're not quite there, that's okay with us. We're still going to be here. We're still going to be giving you more information so you can make a well-informed decision. And yeah, we look forward to seeing you in next week's webinar. Take care.
With the fluctuating change and stability of the American economy, investors have found themselves confused at where to invest their money. Trust is the #1 factor when it comes to cash flow and understanding security of passive income and investing. There is a system that has been developed that is not only secure, but is turning investors into philanthro investors. Investors with ethics, integrity, and the viewpoint that helping families achieve their American dream is still very much alive in the United States today. Equity and Help is a company founded on integrity, ethics, and help. The focus is purely on the concept of helping families move into stable homes, save neighborhoods, and for investors achieve cash flow that is stable and secure. Imagine putting your money to good use and helping families, all the while making a passive income. That is Equity and Help, restoring faith in investing and giving help to families all across America. Learn more and become a philanthro investor at equityandhelp.com.